All right. Well, I think we're going to go ahead and get started. Thanks everyone for joining us today for the Selling Your Landscape or Selling Your Business webinar. We're excited for you to have us here and join us. A couple housekeeping things before we get started. We want this to be as conversational as possible. So if you're on the screen, take a look at the bottom. You'll see two features, a chat feature and a Q&A feature. The chat is public. So if you have something you want to share or want to chat with people, be sure to enter it in there. Otherwise, go ahead and put your questions in the Q&A box. We will save those for the end, and we will make sure we get answers to all of those. Lastly, we are recording this webinar, and we'll be sure to share it with everyone within 24 hours. That way you can come back and watch it, or you can share it with your team. At this point, I'd like to turn it over to Brian Morse from Aspire Software. Brian, take it away.
Thanks, Megan, and thank you everyone for coming on to this webinar. We think this is going to be very informational for you, especially if you're looking at the possibility of getting into the buying or selling business game that's going on right now in especially in the landscape industry. And so we have a number of people, and I'll kind of introduce some of the people here that are with me today. But just to kind of go over a little bit of the agenda, we're going to talk about the whole idea of transition or sale options. Those can be two different things. We'll be talking about the difference between those, an acquisition overview, and kind of this sample timeline. What to expect in that timeline. Valuation, of your business. How is your business being valued? Assembling your deal team. This is a big one, This is the one, I think, key area, in my opinion, that is the most important, Putting together a really solid team, because you're not going to be an expert at either buying or selling. So you need a great team put together to help you through that process. Any open items, that you might have, as you're looking to buy or sell, and then what a buyer asks for, So those are the things that we're going to cover on today's webinar. And then, of course, hopefully we'll leave some time here at the end if I don't yap too much for the Q&A. So that's our agenda. And so who's on the call, today we have Palmer Higgins. Palmer is a partner at Chenmark. And who is Chenmark? They're a team of small businesses, not just landscaping, Chenmark is a conglomerate of different businesses and businesses that are committed, as it says here, to each other, to constantly pursue, to constantly get better and succeed, so they help one another. One of the things that I think is extremely valuable in the way Chenmark does things is they really look at kind of partnering rather than just acquiring, This is they really look at the long term when they're doing things. And so they want, somebody that's going to partner and be a part of this commitment of small businesses committed to one another. And Palmer's, very valuable asset over there at Chenmark. We have the 3 Points group, who I know very, very well. My friends Gloria Palmer and Blue Smiley are on the call with us. They work with companies, They're part of that dream team who help companies, understand where they're at financially, and that's what Gloria is great at. The financial side of things. Blue's an associate over there at 3 Points Group. And Jeff Harkness is again a good friend over there at 3 Points Group, not on the call with us today, but again, somebody that is very, very valuable in that whole dream team. And so what they do, is they're business consultants, and they help you in that succession planning, whether it's transition or sale, whether you're on the buyer side or the seller side, those are the things that the 3 Points Group do, They help you understand how to achieve your goals with your business, kind of from an exit strategy standpoint. And then, of course, who is Aspire? Aspire, cloud-based. I like to call it a work ticket production management earned revenue system, And the importance of Aspire in all this, and why the three of us are on the call, because data, Data is key in the buying and selling of your business, especially if you're going out and looking for an equity partner, right? You need to prove your data. You need to show data and good data, and not just, hey, here's my financials, right? But how did you get to those financials? What are the things you're doing well? What are the things you're not doing so well, right? Because those are the things that companies are going to look for if you're looking at selling, right? And so Aspire helps to gather that data, and then of course in running your business, right, it's obviously the great tool to making decisions to increase profits, right? The better you look, the higher your revenues are, the better your profits are, the more valuable you are going to be out there for those buyers in the market, or the more valuable you're going to be to again attract an equity partner that's going to help you in that in becoming a buyer from that side. So that's who's on the call today. And so I'm going to turn it now over to Blue Smiley. He's gonna take you from here.
Yeah, thanks, Brian. Thanks, Aspire, for hosting this. I think this is just a great topic to be talking about today. I think the topic of selling your business, as Brian mentioned, is being thrown around a lot right now, especially in our industry, in the landscape industry. Every week there seems to be another acquisition announcement on landscape management or lawn and landscape. As many of you business owners can attest to, many of our clients are receiving emails, phone calls, letters from private equity groups, investors, buyers who are trying to buy and acquire their business. I talk to investors and private equity groups every day who are trying to find good businesses to partner with and invest in this green industry. So there's just a lot of activity going on in this space. So I think it's a great time to kind of dig in and talk about it. So excited to be going over that today. I think the best place to start is, if you're a small business owner, what are your options if you want to transition out or sell your company? What does that mean? There's a lot of different routes to take and can be kind of confusing. So I think we just kind of want to focus on the main ones that we see most often. As you guys may know, many companies in the green industry are family businesses. Sometimes we see even second or third generation family businesses. There's always the option for the business owner to transfer the business to their kids. This is a great way to keep the business in the family, make the transition flexible, comfortable, and keep the value of the business to the next generation of the family. There's also a couple of hurdles that come along with that. For one, are the kids actually interested in the industry and the business? Are they capable of taking over the business? A lot of times recently we've seen maybe the kids are in the business, but they're kind of just happy being an employee. They might not want to step into that business owner mentality and everything that comes along with that. And then secondly, and importantly, do they have access to capital to really purchase and provide the owner with maximum value that the business is worth? And that can be a big hurdle too for a lot of this transfer to kids option. But it is a good way to keep the business and the legacy of the family. Secondly, the employee stock ownership plan, or an ESOP. While we don't see this a whole lot in this industry, it's a unique way to transfer and transition the ownership of the business to the employees of the business, especially when the owner may not have kids, or they've been working with the same employees for 10, 15, 20 plus years, and they want to give the employees the opportunity to actually take ownership of the company themselves. Some of the problems with the ESOP or hurdles to get over here, it can be an expensive process. It's a pretty complex process to go through and complicated. It can take a significant amount of time as well. And the transition for the business owner may not be as clean, or it may take longer for them to actually exit the business in that option. Next, the management buyout. Again, something we don't see a whole lot in this industry, but this is an option where it allows the management team to buy out the business owner and take ownership of the company themselves. Typically, this is a really nice transition because more or less the same people that have been running the company are going to continue to run the business. There's a nice comfort level between the owner and the management team, and trust that they're going to continue to take care of the business, take care of the people, take care of the customers, the way they always have been. Kind of similar hurdles to the same transfer to kids option. do they have the capital to actually provide the owner with maximum value, maximum cash upfront to buy the business? A lot of times they don't have that. But again, it's a nice level of trust and familiarity, but there are some hurdles that come along with that option. And then finally, the outright sale. This is kind of your typical option where a business owner has had enough. They want to kind of hand in the keys and have a quick transition out. A lot of times we see this too for business owners, maybe if there's a terminal illness or an illness that makes them no longer able to work in the business. The outright sale offers a very quick transition, and it allows the business owner to really cash out and create and collect legacy money for themselves and their families. Cons here, though, you may be selling to a buyer who you might not know very well. You could be handing in the keys and stepping away, and that buyer may come in and they might not take care of your people the way that you wish they would. They may come in and start changing things in the business with their operations. They may not take care of your customers or clients the way that you would. So there's some uncertainties that come along with that. And then in an outright sale, there's also the due diligence process, which Palmer and Gloria are going to get into a little bit more, but it's a cumbersome process. There's a lot of compliance, legality that goes on there. So another hurdle to kind of go through. But again, it's a quick transition and really allows the business owner to capitalize on and cash out on the business.
One additional point, and Blue, on the kind of the transferring to kids is, right, like you said, the kids' interest, but it's also, right, understanding, are your kids capable to take over your business, right? I've had companies that have sent their sons and daughters to business classes, right, to learn about running a business, because they said, you're not getting the business, right? I'm not going to turn this over to you or sell this to you unless you know how to run a business, right? Because they want to continue the legacy of what they built upon, usually in that case, right? They want to continue that namesake. And so again, identifying and making sure that those kids are ready to take over that role I think is very important.
Yeah, it's a great point. There's a big difference between working in the business and being an employee and then actually owning and running the business. And it's not something you can easily step into. So yeah, great point on that one. So kind of those first few are kind of your classic transition options, typically where, an owner can kind of step out more immediately or quickly. These next few are options where the owner might be required to stay involved, or they might be incentivized to stay involved after a transaction. Remember, a sale here doesn't necessarily mean a transition out. It doesn't mean that you're handing in the keys and walking away in these scenarios. The partial sale, there's times where an owner may want to sell a portion of their company. Sometimes it's an arm or a division of the operations that they want to kind of get rid of so that they can focus on the core business and grow that. More often we see sales to strategic buyers, and depending on the buyer, they may offer the owner the option to roll over proceeds from the transaction into equity in the larger company. And the equity roll is a tool used to create alignment between buyer and seller. Now that the previous business owner and seller has equity in the new larger organization, they're incentivized to remain involved and grow the company and grow the value of their equity that they've rolled over into the larger organization. Ultimately, there will be a second payday when the larger business is sold or recapitalized. It triggers a liquidity event, and all equity holders in the business have the chance to take the chips off the table, cash out, put actual dollars in their pockets, and realize a nice return on that initial equity roll investment. A lot of times you hear this described as the second bite of the apple. And then finally, I think the last option, which probably requires the most involvement from an owner post-close, is a sale to private equity and becoming a new platform investment. In this scenario, a business owner is teaming up with a private equity group who has sometimes tens, 50, hundreds of millions of dollars behind them to pump into the business give them resources, go out and acquire and become a strategic buyer, acquire other small businesses and grow on that initial platform. Again, here, it's very common that the owner is going to roll over a portion of the proceeds into equity, into the larger business, to be aligned with the private equity group to grow the company and grow the value of their equity and realize sometimes a 2 to 3 to 4 times return on their money in a 3 to 5 year time horizon. So those are kind of the options when you think of, a business owner, what do I want to do with my business? I think it's kind of important to take a step back actually and think, what do you want to get out of a sale, or why sell, or why transition? And I would say the number one reason that we see is for an owner to create legacy wealth for them and their family. Just the opportunity to do that in this industry right now with all the activity and demand has never been greater. And it's really exciting that small business owners in this industry can capitalize and create really legacy wealth for them and their families. Partnering with a larger company or a private equity group also allows business owners access to capital that they didn't have before, to make larger investments in their company, and make large investments that they may have not been comfortable making on their own. Business owners get to a point where they're tired of signing personal guarantees for loans, right? It's nice to use somebody else's money to grow the business and again, create value. So reducing their personal level of financial liability is another reason we see people just want to take chips off the table. I think something else we can all agree on is in this industry and all industries, great people are incredibly valuable. And what we see is if you don't give your best people the opportunity to excel and grow and take the next step in their careers, they're going to leave and find that somewhere else. So in a sale or a transition or a partnership, when you enter into a larger organization or grow a larger organization, you give your best people the opportunity to take the next step in their career, step into more responsibilities and grow. And a lot of times that comes with the opportunity to create wealth for their family and themselves as well. And then ultimately, just taking a step back, having more time, spend time with their family, travel, enjoy the things you want to enjoy, and just have the freedom of not being the day-to-day small business owners, another big part of why people take a step out. So at the end of the day, I think these are really great questions a business owner might want to start thinking about. If they think about, maybe it's time where I want to really kind of chase this idea of selling my company. Do you want to sell all of your company? Do you want to completely be out? Do you want to have a role post-close? What does that role look like? Are you open to some of these alternative structures or options that we discussed? Do you have any non-negotiables that you want to make sure that are hit on in the deal process? And I'll also add this, I think it's okay to not know the answer to all of these questions. A lot of times business owners that we work with, they don't know what they want to do post-close. They think they want to take some chips off the table, but they really don't know what it's going to look like. And it's hard to know. The process of selling your business and seeing what's out there can be really eye-opening and revealing. And your answer to some of these questions might actually change during the process. So I just think it's best to go in with an open mindset and trust the process and keep this stuff in mind as you go through it.
So I'm going to step in here and talk about the acquisition overview process. I'll say the emphasis here is on brief. Gloria, Blue, and I are attempting to do in a few slides what objectively could be, a week, a month, the whole college course. So please do ask questions. But at a super 30,000 foot level, acquisition overview, number one is trying to establish value. What is your business worth? How is that determined? How can you accentuate the aspects of your business that buyers are going to view favorably, or vice versa? Understanding timing and the steps associated with them, and making sure you're prepared for them, planning around a decision to sell, getting ready to sell or getting ready to buy. That involves assembling your own team, making sure counterparties have their teams, and really understanding what's about to come, because it is a fairly intense process, or at least it can be. And the more you can plan ahead, the better things will go, and typically the smoother things can go. And so the next slide here really is again a very high level overview of the deal process and timeline. The time ranges here are incredibly wide on purpose, because the ranges are also very wide. Just to give you all a sense, Chenmark isn't a acquirer of small businesses, not just in the green industry, but in industries around North America. We've done acquisitions in as few as 4 to 6 months, and some acquisitions have taken as long as 4 years. And there's obviously a huge sort of period in that 4-year period that not much is happening. And really the focus is on these first 2 stages, the decision to sell, and the selection of a broker, advisor, consultant, or intermediary, someone to help guide you through the process, regardless of whether you're on the buy side or the sell side. The more planning upfront that you can do, the quicker the other processes generally can go, because you'll have clarity. Some of the stuff that Blue was talking about, you'll have a clear idea of what you're looking for. That means you can be much more efficient on some of these other items, marketing your company to sale, or marketing yourself as a buyer, meeting buyers or sellers, having those conversations, entering into an NDA, which is a non-disclosure agreement, just says we're about to share some confidential information. Let's make sure that stays that way. Ultimately, with the goal of signing what's called an LOI, a letter of intent, which is essentially a term sheet. It says we're going to enter into a transaction on roughly these terms, and we're going to go into that due diligence process that Blue talked about. That's a fairly in-depth review of information between seller and buyer, where essentially the buyer is going to be checking off everything they think they know about the business and making sure that it stands muster with documentation, with facts, with figures. If you're on a system like Aspire, it's glorious when you're a buyer. I'll just say that up front. Very rare that you see a business that's on a software as sophisticated as Aspire. So the people that are on this call are already in the top percentile, because that does provide access to your business, and it puts you in a position to frame your business in a way that can be objectively verified from a buyer who might not know anything about you or exactly how your business runs. Ultimately, the goal of due diligence is to sign a deal and to close a deal, regardless of whether you're staying on or you're transitioning out of the business. But again, the purpose here is planning up front in stages 1 and 2 can really streamline stages 3 through 8. And the clearer you can get on your goals and objectives, the better the deal team you can put together, the smoother the overall process is going to be. And then, of course, in order to transact, you have to establish value. Buyer and seller have to establish value. We're going to talk a bit about how value is achieved, but I'll say at the outset, valuation is not a science. Your business is worth what someone pays for it. Certainly people who have experience in buying and selling businesses or in M&A within a particular industry will have a pretty good idea in general of how businesses will transact. But I'm sure Gloria and Blue and myself have all been surprised at the sums of money some businesses have transacted around, both positively and negatively. And that's because buyers view things differently. But at a high level, there's a couple of different ways that buyers approach valuing businesses. One is an asset-based approach, which is valuing your business based on the value of the assets. I'd say it's pretty rare for businesses in the green industry to get valued this way. Typically, it functions as a floor of valuation, that if the value of a business is just the value of its assets, there's really no value in the brand. There's no value in the business processes. There's no value in the customer relationships or in the customer contracts. So the much more common approach is the earnings-based approach, which is essentially a way to say that your business is worth an evaluation of its earnings, and the way that manifests is typically a multiple of earnings. But at the core of that is a buyer is paying for a future stream of earnings that your business will provide them. And I'll say, in general, it can be very tempting to assume that there's a right answer and a wrong answer to valuation, especially if you're dealing with private equity. They can create incredibly sophisticated and well formatted Excel spreadsheets that might give the impression that there's a right answer and a wrong answer. There isn't. It's how someone views your business and what your business can do for them. And that's ultimately the point I'm trying to get across here, is that if you're a seller, the more you can position your business to be advantageous to that specific buyer, the more they will value your business. However they want to approach it, whether it's an earnings approach or an asset approach or a multiple or whatever, what ultimately matters is that what makes your business special, what makes your business, you can accentuate what the strengths are of your business so a buyer can really understand and fully value those aspects. So this slide, admittedly, is a very heavy-handed way to approach this topic. Full disclosure, like nothing here is meant to take away from you and your business's entrepreneurial success story. I've talked to thousands of small business owners over the years, and I've yet to meet one who has not overcome incredible challenges and obstacles to get where they are today. That said, and a bit referencing the previous slide, you need to accentuate the factors that have led to your business being what it is to make sure that a buyer will pay for it the way that you feel it should be valued. So the example I give here is, if you've worked really hard in your business and you've done that by essentially doing a lot of other people's jobs, you've essentially created what's called key person risk or key man risk. And if you're planning on transitioning out of your business because you're tired and you want to retire and you feel like you've earned that, and you certainly have, well, a buyer is going to be very nervous that you're performing a lot of key functions of the business, and having to replace all those key functions is going to be a risk factor and not a value factor. On the flip side, if you've worked really hard in your business to essentially deprioritize yourself, build up your team, and establish core competencies with people who are not you, all of a sudden that business is much more attractive to a buyer, especially if you're not going to be attached to it. And so the point here is to make sure that you are taking steps to accentuate what makes your business special, what makes your business valuable, and make sure that from the eyes of a buyer, they feel the same way. I think, Gloria, you're taking it from here.
Yeah, thank you, Palmer. As Brian talked about at the beginning, we're going to talk a little bit about building your deal team or your dream team on here. As business owners run their businesses day in and day out, year by year, there's going to be a group of professionals that they've relied on for the ongoing operations and well-being of the company. And these people are probably very, very good at what they do, but it's likely those people don't have the skill set that will execute the best transaction outcome for you. It's important to bring people into that team who have specialized knowledge, experience, and negotiation skills. Especially, these are some 3 key areas that we wanted to highlight, because that can be the difference in millions of dollars and a total outcome for you, just based on negotiation alone, and being able to see ahead of roadblocks and prepare you for the best outcome possible. On the buy side, if you want to flip to the next slide, something to keep in mind when you're building your dream team. Again, these people need to be experienced, because the people on the other side of the table, likely they also specialize in transactions. These aren't necessarily general practitioners. So we're going to talk a little bit about parties on the other side of the transaction that these professionals would be pairing up with and advising you through the transaction with. In your transaction, some of the transaction funds may be borrowed from banks or other lenders. If that's the case, a lot of times you can expect extra due diligence and higher compliance and perhaps regulatory requirements. Lenders are by their nature more risk averse than investors. We're talking about equity partners and other investors. A question to ask yourself, have they already raised the money, or are they a group that raises money separately for each opportunity? And if that's the case, will you need to be part of that process? The other group we're going to talk about are third-party diligence teams. And due diligence has been referenced a few times already in this transaction. When you think of entering into a transaction, most people will think of the quality of earnings, because one of the first things you think of is the value and the financials that you'll provide. But that's just one of the diligence streams that you will be working with. Examples, again, quality of earnings, tax, insurance, human resources, information technology, legal, and environmental is another diligence stream. And each one of these could potentially be a different third-party professional, or some or all of these may be handled in-house by whoever is on the other side of your transaction. Again, in assembling your team, because you're going to have people on the other side of the transaction who are specialists, it's very important to have your team experienced and knowledgeable, who can go toe-to-toe with everybody and get you the best transaction outcome possible. Another set of people that will be involved in your transaction are going to be the internal ones. Getting through a transaction can be a full-time job on top of a full-time job. And part of your workload will depend on the strength of the team that you put together to support you. And this involves not only the professionals we're talking about previously, but also likely some key employees. I'll speak about employees first. Generally, in a transaction, there's competing interests between maintaining confidentiality and keeping the wheels of progress turning. You may only share the potential of what's going on with one or two key employees until you're way down the road in your transaction. This is a judgment call on your part, but at any stage, any messaging to employees is very important so they continue to feel secure, valued, and see the broader opportunities and the benefits that are coming from what you're trying to accomplish in the transaction. At the beginning, Blue was talking about the opportunities that can happen with key employees, especially if they're receiving bonuses or equity opportunities with the larger organization, or the opportunity to grow in their own positions because there are more opportunities in a larger organization. And finally, we'll speak to family. Family is very important. And in most entrepreneurial businesses, the business can literally be part of a family, and any changes to your workload or to that business will directly affect your family. That support is very important, as transactions and transitions can be challenging. However, achieving your desired outcome can secure, and you keep saying this, it can secure legacy wealth and security for your family and its future.
So if you're watching this and thinking maybe a sale is something of interest, but a lot's been thrown at you and you're not sure where to start, here's some open items to start. If financials really aren't your thing, you use them just to submit taxes, just know that they're the bedrock that buyers will go to first to understand what exactly they're buying. And so you might want to get moving on that, because that is going to be the first place they look. And we'll talk about, as an example, what Chenmark will ask, right after an initial meeting with a seller, to give you an example there. valuations based on desire, not reality. If you don't know what your business is worth, call up someone like Gloria or Blue and ask, and think about engaging with a broker, an intermediary sooner rather than later. They can help you plan. They can help you understand what your business might be worth today. And more importantly, they can help you understand what your business could be worth if you could clean up a thing or two, or you can enhance something. Running high levels of personal expenses through your business, totally get it. It is a great way to save on taxes, but it will hurt you in the long run when selling your business. It is the hardest thing to diligence. It is the most painful thing to diligence. My guess is Gloria and Blue would agree. It can be very cumbersome and detrimental to getting a deal done. And so just something to be aware of. Unclear motivation for sale. I think this actually works two ways, especially when you're talking about a third-party buyer. They don't know you, you don't know them. If you don't have a clear motivation for sale, a buyer is going to be nervous about what they don't know and how it can hurt them. And so if you have an unclear motivation for sale, it can be a red flag to a buyer to always wonder, what am I not uncovering that this seller knows that I don't? On the flip side, if you have an unclear motivation for sale, you might be looking at the wrong buyers. You might be marketing your company in the wrong way. You might not actually be engaging in the type of transaction or transition that you ultimately in your heart of hearts really want. So again, understanding exactly what type of transition and or transaction you're looking for can really streamline the whole process. And then a poor company culture. This is going to impact the business regardless of whether you want to sell it or not, but especially if you're transitioning out of the business, what a buyer is acquiring is not just your hard work over the years, but they're acquiring your team. And if your team has poor culture, there's almost no set of data or financials or profitability that's going to convince a buyer to get into that. And so if you don't have the team that you would want to go to war with, for lack of a better phrase, getting that team set up, because a strong team is an incredibly alluring aspect to an acquisition.
Yeah, and just to kind of add on that company culture, I think that's key from both a buyer and a seller side. We were actually, as people that are with Aspire know, we were acquired a little over a year ago. And one of the things we looked at when we went out to visit Service Titan, when we were still in the dating phase, was what is their culture, right? We wanted to be sure because we knew we had a great culture. We wanted to be sure that we were joining and partnering with another company that had the same like culture, right? Because we cared about our people and we didn't want, this to be a disaster for the people at our organization. So it was very important to us, even from a seller's perspective. So if you're out there selling, right, to somebody, don't just think about your people at your organization and how much, especially if you're transitioning out, how much you do care about those people, and make sure you're, looking at the company culture of the buyer.
Yeah, I think that's a great point. And I do think it works both ways. If you're a seller, you should feel absolutely entitled and welcome to explore the culture of the potential buyer. What are they going to do with your business? What are their expectations? What are their plans? They're not you, so don't expect them to manage or operate the business exactly the way you would. But if you have some deal breakers, or you have some things that you really want to make sure are taken care of, that's an important part of a deal, for sure. For sure. So last, and then we'll open up to questions. This is just a really quick hit of sort of what a buyer asks for. This is what Chenmark would ask for at a very early stage. This is not what Chenmark would ask for in the due diligence stage. I would consider this the ante, to use a poker phrase, of sort of what we'd be asking for in that initial wave of information to see if we really want to move on to a letter of intent, which is a version of an offer and an indication that you're going to engage in serious due diligence. So 3 years of financials and tax returns, making sure that they tie one to the other is an important piece. If they don't, that is another place to look. Asset lists, so equipment, vehicles, anything like that, when it was acquired, how much it was acquired for, potential condition of it, especially if you're in a more asset intensive business, some sort of employee census with bios, who your team is, how long they've been with you, what role they occupy, maybe a bit of a bio, what their compensation history has been, they have any incentive compensation structures in place. And then data on services and customers, very broad here. At this stage, it would probably just be sort of customer analysis type stuff, but also any key service agreements or data on contractual arrangements as a buyer, understanding where the revenue is coming from and how certain that revenue stream is into the future is a very important part.
Yeah, I think, and again, to kind of pat Aspire on the back a little bit, right? That's the key element, right? Is the data on services and customers, right? Capturing that data. A lot of companies that don't have the technology or the software, right? They have financials, they might have financials, but they don't go down anywhere from there, right? They don't really know how well they're performing work for a particular customer. Sometimes they don't even know the length of time that a customer's been a customer at their organization, right? And that can play into it, right? If I have 1,000 customers that have all been with me for 10 years, that looks good to a buyer that's going, hey, are these people going to stay with this company? Well, of course they are. Look at the longevity they've had. But then again, not only on the customers, right, but the services, right? What kind of services are we providing? What's the data? What's the profitability? What's the, how well are we performing the different services at these particular customers? So Aspire provides all of that, as Palmer mentioned earlier, right? It's really to walk into these things. A lot of times, Palmer and Gloria and Blue, they're walking into these things and people just have spreadsheets and they don't have a lot of good captured data, right? Aspire gives you that ability to have that data where it needs to be when you're in this process, and it makes that process, again, looking at the timeline, it kind of shortens that timeline a little bit because it opens up that data to the buyer or the seller.
I'll add that not only does it open up the data, but it opens up the data at a level of depth that is going to be impossible without software. And so not only is that attractive to a buyer, it allows them to drill down and really get their hands around something and feel like it's solid, but it's going to give you the data you need to make your business better, even before you want to sell, right? And so you'll know what is going well and what needs work. And so you won't have any surprises when you go into a diligence process and buyers are looking over every single stone they can think of to make sure that there's nothing they're missing.
All right. So we did have a few questions that came in. So I'll hit the team up with this question. And I warned the team about this because they were, I knew it was going to come up, but after EBITDA has been determined, several multipliers have been discussed. What's the range of multipliers that are currently being used? So I'm going to let the team talk about it because I warned him with this question.
Yeah, I mean, I can take a crack at it, Palmer, feel free to add whatever you want to, but we knew this question was coming, and I wish the answer was simple. I think we all wish it was a simple answer and we could give you an exact range, but the best way to say it is, unfortunately, it depends on the business, right? It depends on what services you're performing. In this industry, we see maintenance-focused businesses are more valuable, and the multiple is probably going to be higher on maintenance-based businesses versus companies that are doing a lot of new projects or new development. It depends on your margins. If your margins are better in your company and your business, that's going to create value in the multiple, and that company may be higher than a similar company that has much lower margins, even if you're creating the same EBITDA. So unfortunately, it just depends on the business, the type of business. And at the end of the day, like Palmer said it best, the multiple, it really is just a reality of what the buyer is willing to pay. So that can really flex and change.
Yeah, I don't have much to add there. It depends is the right answer. I'll give a couple of just examples. If you have $1 million EBITDA landscape maintenance business versus a purely design build construction type business, also earning $1 million in EBITDA, generally speaking, buyers are going to favor the maintenance business because typically that revenue is going to be contracted out for some time, and a buyer is going to value the security of the future revenue and therefore presumably the future stream of profits, more so than the construction business that's going to have to each year sell new construction jobs in order to keep meeting that profitability and that revenue stream. On the flip side, you could have two $1 million EBITDA maintenance businesses, and if in one the owner operator is the head salesperson, the head account manager, and the head operations manager, and the other, the owner operator is purely more of a CEO function and has a head salesperson and has a team of account managers and has a team of division managers or operations managers and is really more focused on strategic oversight and direction, that business is going to be more valuable than the one where the owner operator is performing multiple different job functions, because those roles are going to have to get replaced if the owner wants to step out. And so that's why it's fundamentally very difficult to say if EBITDA equals this, value equals Y.
Yeah, awesome. Another question that just came in: does all debt need to be settled at the close in a partial acquisition, not a full sale, but does debt have to be closed? Anyone that wants to jump in on that one? Blue, maybe you've got some insight on that.
Yeah, Palmer, I might throw that to you. We typically don't work with partial sales quite as much as maybe you guys do.
So we don't do partial acquisitions either, but I'll say at a high level, as long as two people sign on the bottom line, you can do whatever you want. That's what I've learned about contracts and law, is that if buyer and seller both sign, you can basically write whatever you want. The distinction there, I would say, is probably one between a different type of purchase. Is it going to be an asset purchase or a stock purchase? And in a stock purchase, it's much less likely that debt's going to have to be repaid down. But I would say structure and financing are two separate types of discussions. And unfortunately, then I would say it depends as well. For sure, if you're going 100% sale structured as an asset sale, highly likely that the debt will have to get paid down. But I know that wasn't the exact question.
Yeah, no, but I think that's a great answer. Thanks, Palmer. Just so that everyone knows, we are going to be sharing out this recording and the slide deck to everyone. So if you did miss something in the slide deck, you will get this if you were registered for the webinar. So we're going to be sending this all out to everyone. One more question before we close here. For EBITDA company purchases, how does the company's owned equipment value weigh on the purchase cost, or is it factored in the EBITDA multiple? Gloria, do you want to take that?
Yeah, I guess I can take this. The value of the assets, if the company's being valued as a multiple of the EBITDA, that doesn't directly weigh into that valuation, but where it comes out is in the multiple that's being paid. If a buyer comes in and it looks like you don't take care of your machinery and they are going to have to put a lot of work into it, I guess not only could it be a lower multiple, but they may actually, I've seen this turn into what's referred to as like a debt-like item, where they may do a calculation of how behind you are in your CapEx replacement, and it could come off of purchase price. And now I'm getting too detailed, but that's where that could weigh. And I would say a well-maintained fleet and equipment kind of almost plays into the concept of culture at the company. You take care of your people, you take care of your vehicles, you take care of your equipment. It comes out in the company, and it really will come out in that it translates into dollars in the multiple.
Awesome. I think that's all the questions we have today. And so for me personally, I want to thank everyone for coming to this webinar, and also want to thank all of the participants here, including Megan and Abby, who didn't do a lot of talking, but played a very integral role in this. Again, there's resources out there. We did a little seminar at our Ignite conference. If you are an Aspire client and want to talk to our M&A team at Service Titan, they're happy to have conversations. We have Gloria and Blue and Palmer also as well. more than happy to have conversations and extend a discussion. So, you know, feel free, you see here, feel free to reach out. Here's our contact information, you know, feel free to reach out with additional questions, or, you know, if you're looking to buy or sell, there's some great people on this call to add to your dream team, because these people really know what they're doing out there. So again, thank you all for attending the webinar.